Welcome to Talk Tickers. We dive into earnings calls to pull out the key insights for experienced investors like you.
And today we're digging into the Walt Disney Company's second quarter for fiscal 2025.
Yeah, quite a call. So just hitting the highlights first. Adjusted EPS jumped 20% year over year. Pretty strong start to their fiscal year.
Definitely. And the experiences segment, especially domestic parks, look really robust.
Right. And we also saw some, promising signs from the streaming business, too, on revenue and actually getting towards profitability.
Exactly. So the overall feeling, the outlook for the rest of the year seems pretty optimistic based on the call.
Okay, let's get into the weeds then. Experiences first.
Makes sense. I mean, a standout metric was the return on invested capital for experiences hitting an all-time high.
An all-time high. That really says something about how they're running those businesses, doesn't it?
It does. It points to, well, significant efficiency and strong profitability, right, especially in the parks and related areas.
And you mentioned domestic parks specifically. Margins there were up, was it 810 basis points?
That's right, 110 basis points.
So what's behind that number? Is it just ticket prices or?
It's a mix. You've got strong performance in the parks themselves, definitely.
Yeah.
But they also called out the cruise business.
The cruise line. Contributing significantly then.
Yeah, it seems particularly accretive to margins. Suggests their investments there are really working.
And speaking of investments, they announced that huge number, over $30 billion for Florida and California parks.
Yeah, that's a massive commitment.
What's the strategy there? Just building more stuff?
Well, yes, but it's strategic. It's about increasing capacity, meeting that demand, but, and this is crucial, without hurting the guest experience.
Tricky balance.
Very tricky. And the specific projects they hinted at, new lands based on popular IP like Villains or Cars, Pandora, Coco. It's about keeping things fresh, keeping people coming back.
Makes sense. Keep the core strong. But then there's the completely new venture, Abu Dhabi, a seventh park.
That's a big move. Partnering with the Morale Group there, Disney handles design, IP, operations expertise.
And Morale brings the capital and construction.
Exactly. And the potential market is, well, huge. They're talking about reaching 500 million income-qualified people within a 4-hour radius. Middle East, Africa, India, Asia, Europe.
Wow. And Abu Dhabi itself is aiming for massive tourism growth.
Right. 39 million tourists projected by 2030. So Disney's tapping into potentially enormous underserved demand. It's a major global play.
Okay, so that's the future vision. How's demand looking right now in the existing parks?
Domestic bookings look pretty solid. Q3 projections are up 4%, and they're already about 80% booked.
80%, okay.
And Q4 is looking even stronger, projected up 7%, with around 50 to 60% booked already. So domestic demand seems quite healthy.
What about international visitors coming to the U.S. parks? Are they back?
Not quite to pre-pandemic levels, still in the double digits, apparently. But the key thing is strong domestic attendance is more than making up for that shortfall.
Got it. And you mentioned the cruise line earlier, the Disney Treasure Ship, getting good feedback.
Very positive, yes. It sounds like they're nailing the integration of Disney IP into the cruise experience.
And learning from it for future ships, too.
That's the plan. Continuous improvement, more IP integration. Seems like a real growth area within experiences. Plus, they mentioned expansion plans basically everywhere, globally.
Okay, let's switch over to entertainment. Movies, TV, sports. The Thunderbolts movie seems to be doing well.
Yeah, #1 worldwide, best reviewed Marvel film in recent years, apparently. That's definitely a positive sign for their feature film strategy.
Good news for Marvel. And the upcoming slate looks packed, too. Lilo and Stitch, live action, Pixar's Elio, Fantastic Four.
Right, Zootopia 2, Avatar, Fire and Ash. They seem quite bullish on the next year and a half, comparing it to the strength of their 2019 slate.
2019 was huge, so New Avengers, Mandalorian movie, Toy Story, Moana live action.
Exactly. A lot of big potential hits lined up.
Interesting note about Marvel focusing more on films, less on the Disney Plus series. What's the thinking there?
It seems like a strategic shift. Maybe trying to enhance the quality perception. Focus resources on fewer, bigger theatrical events that really make an impact.
Create those big cultural moments again.
Potentially, yeah. Which could then feed back into interest for the streaming service anyway.
Makes sense. Now, ESPN. That Q2 primetime audience jumped 32% in the 1849 demo. That's significant.
Very significant. Their most watched Q2 ever for that demographic. It was driven by, well, the usual powerhouses. NFL, college football, but also the NCAA women's basketball tournament, which was huge this year.
Really shows the power of live sports.
Absolutely. And speaking of sports, The ESPN direct-to-consumer offering is getting closer.
Ah, yes, the flagship streaming service. What's the latest?
Well, they said it's a few months away. Pricing and timing details are coming soon. Key point. Current linear ESPN subs will get access automatically.
Oh, interesting. So it's not like a completely separate thing you have to buy.
Not if you already pay for linear ESPN, sounds like. Though they mentioned the DTC version will have additional features. And they are not calling it ESPN flagship, by the way.
Okay, noted. And they mentioned giving Disney Plus and Hulu subs a taste of live sports.
Yeah, seems like a strategy to, cross-promote and drive signups for the main ESPN DTC offering once it launches. Get people hooked on the sports content.
Smart. Okay, moving fully into streaming then. Integrating Hulu content sports onto Disney Plus. Is it working?
Seems to be. They reported higher engagement and, importantly, lower churn since doing that.
Lower churn is always good news. Makes the platform stickier.
Definitely. And their future plans involve more integration. That smart bundling with ESPN DTC we just talked about. Tech improvements like paid sharing, better ads.
Paid sharing, cracking down on password sharing.
That's usually what it means, yes. Along with personalization and ad tech improvements. Plus, more investment in international content.
So tech improvements coming soon.
Near term, yes.
What about the ad market? How's that looking for Disney?
It's a bit mixed, according to them. Live sports advertising, especially ESPN, is very healthy, up over 20% in Q2. Strong demand from restaurants, healthcare.
But the general streaming ad market?
That's more challenged. They mentioned increased supply across the marketplace. But overall, they actually expect their total ad growth for the year to be better than the 3% they initially projected.
So navigating it, okay, what about guidance? They raised the EPS forecast for this year, right?
They did. Fiscal 25 adjusted EPS guidance is now $5.75, up from $5.30.
That's a decent bump.
It reflects their confidence. And importantly, they kept their long-term guidance for double-digit earnings growth in fiscal 26 and 27.
So they see the streaming business really driving leverage.
Yeah, through both revenue growth and, over time, cost cuts, especially in G&A and marketing, though they might reinvest some savings into more international content.
Okay, last thing, any comments on the broader economy? Macro trends.
They acknowledge the uncertainty out there, but said they're encouraged by how resilient their businesses seem to be.
What about China? They mentioned softness there before.
Yeah, they said it hasn't gotten worse. Attendance is apparently still good, but people are spending less per visit, which they attributed to the economic climate for Chinese consumers.
Understandable. And the overall guidance for experiences for the full year?
Unchanged on the range, still 6-8% growth, but they now expect to be at the higher end of that range.
Okay, so still feeling good about the parks and experiences overall.
Seems that way, yes.
All right, that brings us to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on this call.
Okay, let's think. Given that really strong performance and the big future plans for the experiences segment, especially that massive Abu Dhabi project.
Yeah, tapping into that huge market.
Right. So here's an idea. You could consider looking at companies, not Disney itself, but firms that specialize in developing and operating large-scale entertainment infrastructure, specifically in the Middle East.
Okay, why?
The thinking is, if Disney's Abu Dhabi park is a big success, it could create a kind of halo effect. Increased tourism, more demand for related services, infrastructure builds, benefiting those specialized regional players.
Interesting. Playing the ecosystem around Disney's move. Highly speculative, though.
Oh, absolutely. Highly speculative. Depends entirely on Disney executing well in Abu Dhabi, regional stability, all sorts of factors. Definitely not investment advice.
Got it. Outrageous but plausible. What about another one?
Okay, second idea. Thinking about that strong film slate they talked about for the next 18 months. Marvel, Avatar, all those big tentpoles.
Potential return to 2019 level strength.
Exactly. If you believe theatrical releases are poised for a real comeback, maybe you could explore a paired trade.
Paired trade. How?
Go long on cinema chains with a big global footprint, betting on increased box office numbers. But hedge that by going short on some at-home entertainment companies that maybe benefited disproportionately from the pandemic stay-at-home trend.
So betting on people going back to the movies in a big way and maybe spending less time just streaming at home.
That's the core idea. It's definitely a contrarian view, relies on a sustained shift back to theaters. Again, high risk, depends heavily on consumer behavior really changing back.
Two very different thought-provoking ideas there. Okay, that pretty much wraps up our deep dive into Disney's Q2 call.
Yeah, covered a lot. Record returns and experiences, the big Abu Dhabi move, the streaming progress, shifts in content strategy.
Definitely a lot happening. The Abu Dhabi expansion is fascinating, and watching how they balance streaming profitability with content investment will be key.
Agreed. Lots to track going forward.
So what stood out most to you from this discussion? Remember, these are just our takeaways. Always do your own thorough research before making any investment decisions.
Absolutely. Thanks for tuning in to Talk Tickers.